tonight we're going to kind of see the convergence of a number of topics that we've talked about for the entirety of the semester. Okay, so we started off the beginning of the semester fairly basic with the income statement and the balance sheet, and then we moved into projections of what the future was going to look like for a particular business. And then we took it to the project level where we were forecasting what the incremental value that certain projects were forecast to deliver to the firm based upon some project cost, right? So you had some expense that you were looking at shelling out today in order to deliver some future series of cash flows, all right? And we needed to bring those future cash flow dollars back into today's dollars. And so we discounted all of those future cash flows using the discount rate, okay? And when we were having the lecture on the time value of money and the very basic future value formula, FV equals PV times 1 plus the rate to the time period, okay, we were using some expected growth rate. Okay, so we had this word growth rate. We had this word discount rate. We talked about cost of capital. We talked about weighted average cost of capital. We talked about IRR, okay? So tonight, we're going to kind of see how all of this comes together, okay, in terms of how your companies, okay, and how most companies who are financed with both debt and equity, and I apologize if you hear a dog barking in the background, our 14-week-old golden doodle has decided that it's really fun to bark his way around the house. So please forgive the barking in the background. But we're going to see how weighted average cost of capital equates to expected return, like we've been talking about from CAPM in the securities market line, how it equates to yield to market when we were doing bond valuation, okay, and how the cost of debt and the cost of equity come together based upon their relative proportion to the overall firm's value, okay? How the cost of each of those components on a weighted average basis creates the weighted average cost of capital for the firm, against which all of your firm's projects are measured against, okay? Your company, your treasury department, your cash management department, your accounting department, could be all three of them, could be one of them if you work for a smaller company. But nonetheless, if the business is financed with debt and equity, and most are, all right, then you will have a weighted average cost of capital that your firm will use as a measuring stick against the value of all the other projects that your company is looking at implementing. Okay, so tonight we're going to get into how do we go about calculating this very, very important number, okay, that you've seen before already. You've used it before. You've used it in the discounted cash flow valuations, project analysis, calculating net present value, determining IRR, calculating the spread to WACC. What's the IRR spread to your weighted average cost of capital? Always a very important number because it gives kind of an absolute value number of what value an actual project is delivering above and beyond the weighted average cost of capital, okay, for a particular risk level, right? And then at the end of the lecture tonight, we will see how to go about calculating this weighted average cost of debt, cost of equity number that we call the weighted average cost of capital that all projects are then measured against when we do net present value and DCF valuation, okay? And then after we get through the lecture, we're going to talk about the assignment for this week, okay, which has been posted on to Moodle. It involves the British Royal Mail delivery service. okay? And you're going to have to calculate what the weighted average cost of capital is for the Royal Mail based upon the data that you're provided. And after the lecture, you'll be able to do that fairly easily, okay? The exhibits that are in the case have already been translated into Excel, so you won't have to deal with that. But nonetheless, you'll still need to use the Excel file as your basis for determining what the weighted average cost of capital is for the Royal Mail, okay? So I'm going to go ahead and we're going to get started tonight on the WACC. And then towards the end of lecture, after we get through that, we're going to go ahead and also talk about the final exam and our last lecture next Monday to see if you guys have any questions about that. Sorry, I was doing some work here on a few slides. Okay, so tonight, the objectives are really for us to kind of get into the nitty-gritty on how we go about calculating the firm's cost of equity, the firm's cost of debt, okay? How do we go about determining the firm's overall value, okay? And how do we use these costs of capital, okay, in determining how we value the firm, okay? And then finally, we're going to get into some of the pitfalls that are associated with the firm's overall cost of capital and how do we handle those things. Because in everything, right, as we've talked about throughout the course of this entire semester, right, it's kind of an art, okay, finance, right, discounted cash flow valuation, weighted average cost of capital. It's a bit more of an art than it is a science. Okay, so there are always going to be pitfalls with whatever analysis you choose to use, but as long as we understand how we're going about the process of determining the WACC in this particular case, okay, then we can better justify why we did things the way that we did and better justify the final number that we eventually calculated that we're going to use for the firm to then analyze projects against. Okay. Okay. So why, and when we get into the Royal Mail case a little bit later, these are going to be some of the things that I want you to start thinking about. Why is the cost of capital important? Why do we even look at it? Okay. So there's a couple of key points here. Right? We know that the return that we've earned on our assets, okay, depends upon the risk of those assets. Okay, we've talked about this time and time again. You should always be rewarded for the level of risk that you're taking. Okay, so if you have high risk endeavors, if your company is involved in, upstream gas exploration, and you are trying to determine how many proven or unproven reserves of natural gas or NGLs are in the ground 100 feet below you, okay, that's a little riskier, okay, than making toilet paper. Okay, so if you're going to take on risk, then you should be rewarded for the level of risk that you're taking. So we know that riskier assets should deliver higher rewards. That's what we care about. The expected return of risky endeavors or companies that are involved in riskier endeavors than others should have a higher level of return on average compared to less risky assets. Okay. So therefore, the return that the investor expects to receive from the company, okay, is the same as the cost to the company. Okay, the expected return for us as investors in a risky business should be the exact same expected return as that of the company, because if we're dealing with efficient markets, remember this, if we're dealing with efficient markets, then all of the information is public and made available. Okay, so the return to the investor is the same as the cost to the company. Okay, so our cost of capital provides us with an indication, okay, of how the market sees the risk that's associated with the assets that we have. So when we calculate the cost of capital, our cost of debt, and our cost of equity, and we come up with a number, okay, we can then, or the analysts, the Wall Street analysts, for companies within the same market segment, okay, we can start to compare the weighted average cost of capital from one company to the next to determine what the expected returns are for different companies operating within the same market segment. And in theory, okay, if we're operating in the same market segment and we have one company with a higher cost of capital than the other, okay, that is telling us what underlies all of that, right, is the level of risk that's involved with that business. Okay, so if we have a higher weighted average cost of capital or a higher average cost of capital in company A than company B, we should expect to see a higher return in company A, the one with the higher cost of capital. Okay, but remember, what also comes along with a higher cost of capital, aka higher expected return? Anybody remember what also comes along with that? What other statistical measure? And standard deviation, right? What's standard deviation a measurement of? Hold on, I don't have a chat room. There we go. Thank you, Eric. Wider deviation, more variation, right? So if you have a higher cost of capital, aka higher expected return, okay, that also means that you're willing to accept a higher level of variation around the average return, which means you'll have a higher standard deviation, aka more risk. Okay? So when we have an idea or an understanding of what our cost of capital is, this can help us determine, okay, what our required returns are for capital budgeting purposes. So when we know how much risk is inherent within our business based upon the decisions that have been made by our investors in terms of debt and equity financing, okay, when we know now what our cost of capital is based on debt and equity, it gives us a benchmark by which we can then compare the expected returns for the projects that we're looking at, and we can examine those returns against this benchmark cost of capital. And then we can say, for the firm as we exist today with the debt and equity financing that we have in place, okay, we will either accept or reject the projects that we're looking at. Okay, because if we have a project that delivers positive net present value and the discount rate that we're using within our net present value discounted cash flow valuation model is the cost of capital, is the discount rate, is the weighted average cost of capital, then if it delivers a positive net present value, then we know that that project is delivering additional value to the firm above and beyond what the firm could expect to receive, okay, in just its normal business operations. Okay, hence why we accept positive net present value projects. So when we think about the required return, right, we're going to be talking about the debt and the equity of the business, the financing aspects of the business, right? We're talking about investing in our firms. And when we talk about investing in our firms, we go about getting money two ways. We either access the debt market or we access the equity market. Okay, so the required return, okay, is the same as the appropriate discount rate that we've been talking about all semester. Okay, and it's based upon the risk of the cash flows. Right? When you went through the Heritage Dahl Excel analysis, okay, you were given two projects with two different levels of risk, right? And the riskier project carried the higher discount rate, carried the higher cost of capital. Okay. Riskier projects have higher expected returns. Plain and simple. So we need to know what the required return is for an investment before we can go about calculating the net present value, okay, before we can go about deciding which project we're going to select. Okay, and not every project is going to be mutually exclusive. Okay, you'll be able to do multiple projects throughout the year, depending upon the total pool of dollars allocated for your capital spend. But the point is, you have to know the required rate of return. You have to know how to treat those future cash flows, whether they're riskier or whether they're less risky compared to the normal business operations of the firm. So we need to earn, at a minimum, we need to earn at least the required return to compensate the people who are injecting money into our business, debt or equity. Okay, the investors, we have to compensate them for the financing that they've provided. Okay, so transport back in time for a minute to prior to the midterm, where we were talking about net present value. Okay. And we started to bring into the conversation the calculation of internal rate of return, IRR, right? And we said that the internal rate of return, okay, was the rate of return that was required in order to set the net present value equal to 0. Okay, so if we had an IRR of 17 and our discount rate, AKA cost of capital, was 12, okay, then our internal rate of return was 17. Okay, we would need a 17% cost of capital in order to create a net present value that was equal to 0. Okay, so we had a spread to cost of capital of 5%. 17% minus 12% equals 5%. Okay, which means we would have had a positive net present value. Okay, so as we're going through this, I want you to start thinking back to all of like these little pieces of data, knowledge nuggets that we've talked about throughout the course of the semester, because it's all going to kind of converge here in about 5 slides. And it's going to converge both not only from the time value of money standpoint, where we're dealing with a rate of return, or the dividend growth model, where we're having an expected return with a growth rate of dividends, but it's going to converge also with bonds, because we're talking about the cost of debt, which deals with bond valuation, and we're talking about the cost of equity, which deals with dividend growth model and CAPM. Okay, so we're bringing everything kind of together now to figure out how firms go about determining their total weighted average cost of capital. Okay, so when we think about the cost of equity, all right, the cost of equity, right, is the return that is required by the equity investors. Who are the equity investors? Who are the equity investors?
The company.
What's that?
Is it the company?
Nope, not the company. Us, people who buy common stock, right? Preferred shareholders, people who are buying the common stock of the company, right? That's us, okay? The equity investors are us as people, okay? It's the common stock, it's the value of the firm. So it's, and I apologize, who said that it was the company?
It was Jared.
Jared, yeah, okay. So there are things, yes, there are things that companies can do to essentially become investors in themselves, all right? Addition to retained earnings, shareholder equity, all of that kind of flows in together to equal the equity component of the business, right? So I apologize for shutting you down and saying no right off the bat. You are correct. In the context of kind of the next slide or so, we're going to be talking about what that expected return is, more so from the standpoint of the market capitalization of the firm. Okay, so you're not wrong. It's just a little bit of a tweak to what we're going to talk about here for the next couple slides.
No worries. Thanks.
Yeah. So the cost of equity is the return that's required by the equity investors, which could be either like Jared just pointed out, addition to retained earnings, which is obviously the firm's contribution to equity, but also us as shareholders. So we have risk that's associated with the cash flows. We have business risk, we have financial risk, we have regulatory risk, we have political risk, as we're about to find out what's going to happen, right? So there's a lot of risks that impact the equity component of, or the equity value, the cost of equity for a firm. And as we've talked about over the last couple of lectures, right, we had two primary methods for how we went about determining what that expected return, right, for equities was, right? What's the cost of equity, right? Cost of equity equals expected return of equity equals dividend growth model equals CAPM or security market line. Okay, so you're gonna see some things that just bring it all together now as it relates to equity. So when we talk about the cost of equity, right, we had the dividend growth model, if you remember, that dealt with the current price of an equity was equal to the next dividend payment divided by the expected return minus the growth rate of the dividends. Okay, and if you need to go back and refresh your memory on that, that would have been 2 lectures ago, I believe. Right? So when we rearrange everything, the expected return, okay, is then equal to the future dividend divided by the current price, okay, plus the growth rate. That is our expected return. Okay. Dividend yield, capital gains yield, total return. Okay, remember, total return, aka expected return, is comprised of, okay, the dividends you receive, the yield on the dividends you receive, and the growth of the underlying stock. And we said that because you could push out the time frame within which you sold the stock that you owned to infinity, the value of that future sale, that cash you have coming back in the door from the future sale of that stock, that value essentially goes to zero, and all you're really left with in terms of future growth is the growth that's associated with the dividends. Okay, so when we talk about the expected return, okay, the cost of equity from a weighted average cost of capital standpoint, the expected return is the anticipated dividend divided by the current price plus the growth rate. Okay, you've done this, right? And this, I mean, this was on the Connect homework. This was in some of the Heritage Doll analyses. This is also going to be something you're going to see on the final exam. Okay, so if we think about what the expected return is for a company that's expected to pay $1.50 in dividends next year, okay, and they've had steady growth of about 5.1% a year, right? And the current price is 25. What's the cost of equity? Remember, cost of equity, aka expected return, future dividend over current price, so dividend yield, okay, plus capital gains yield equals total return, aka cost of equity. So the expected return or the cost of equity in this example is 11.1%. Okay, so you didn't realize a couple lectures ago that when you were doing this math to solve for the expected return of equities, that you were actually already solving for the cost of equity, part of the cost of equity, within the weighted average cost of capital analyses. Okay. So when we think about estimating what the dividend growth rate is, you know, out there, you know, in the real world, you know, with your companies that pay dividends, right? It's not necessarily going to be like a specific 5% every year or 4.5% every year. But your company, your board of directors will attempt to maintain a reasonably consistent, if you will, dividend growth rate. Okay. So one method for how we go about estimating the growth rate is we just look at the average. All right, we just go back in time and we look to see how the dividend growth rate changed year over year, and we just do a straight arithmetic average, right? Which gives us a reasonable approximation, okay, of what we could expect in the future. Okay, so the advantage to this is it's a piece of cake, right? In 5 minutes, you can go back and you can calculate the weighted average dividend growth rate. Piece of cake. Okay. Problem is that it's really only applicable for companies that pay dividends, right? Because if companies don't pay dividends, then the only expected return is the anticipated growth rate of the underlying stock itself. Okay. So what happens when we get into those modes, and we're not going to deal with that in this course, but there are other methods that we can use to go about valuing the enterprise value for entities based upon the discounted cash flow valuation and the number of shares that are outstanding in the market. And we can go about calculating what a fair value price is for the stock. Okay, but for the purposes of this course, we deal with the dividend growth model. Okay, and it's also not applicable for dealing with companies that have non-linear, lumpy, if you will, lumpy dividend growth rates. Okay, so we have to make a couple of assumptions here that get us reasonably close, but it's not 100% accurate. Nothing is. So we assume a constant dividend growth rate. All right, so if we go back and we look at the last 10 years of a firm's dividend payouts and we determine that it's a 5.1% growth rate, okay, then we have to make that assumption that that's what's going to continue into the future. Okay, and as you can see from the model, that it is sensitive to growth rate changes. So any 1% increase in the growth rate, okay, will increase the cost of equity by 1%. Plain and simple. That's just the math. The math shows that. All right. So and then finally, a key point here is that it doesn't explicitly consider the risk associated with the business. Okay, so we talked about the securities market line and CAPM and how beta, the systematic risk of a firm, impacts the expected return of a firm. So the dividend growth model doesn't really factor in the inherent risks to the firm. Okay, which leads us to the second method of determining the cost of equity. Okay, so the dividend growth model is one method of determining the cost of equity, aka the expected return using the dividend growth model. Okay, but the second method, all right, that we talked about last week, okay, was the security market line approach, the CAPM approach, okay, which utilizes the risk-free rate of return, utilizes that market risk premium, okay, and then utilizes beta as a measurement of the firm's systematic risk, okay, to determine what the expected return of a particular equity is. So the SML approach, okay, brings risk into the equation, brings a risk premium into the analysis, something above and beyond that risk-free rate that we're expecting to receive, okay, to determine what the expected return is, aka cost of equity. Okay, so if we have a company in this example that has an equity beta of 0.58, okay, so in terms of systematic risk, okay, risk that's inherent in the system, risk that cannot be diversified away, okay, this company, okay, has 42% less risk than the overall market, because we said that the beta of the market is always equal to 1, okay, when the markets are in equilibrium. Okay, so the beta, so this has less systematic risk. This company has less systematic risk than that of the market, okay, by 42%. The current risk-free rate is 6.1%. Okay. And if we have an expected market premium of 8.6%, okay, then we simply use the CAPM model to determine our cost of equity. Okay. Risk-free rate plus beta times our market risk premium gives us 11.1%. Okay. So this is an important note, right? You can calculate cost of equity using the DGM, and you can calculate the cost of equity using the CAPM, right? And in this case, both of them were equal to 11.1, right? So both models yielded the same result, okay? Which gives us some comfort that 11.1 seems reasonable, okay? And we don't necessarily need to make any other assumptions in order to go about calculating what the cost of equity is for the firm that we are analyzing. Okay. So if they're close, if the DGM and the SML/CAPM approach are similar, then we should feel pretty good about the analysis that we've completed. So just like with the DGM, there's advantages and disadvantages to the CAPM. Right? The advantage is it adjusts for the systematic risk, something that DGM doesn't factor in at all. Okay, and it's applicable for all companies as long as we are capable, okay, of using a correlation and covariance calculation to determine what the beta is. As long as we can calculate or estimate what the beta is, then it's applicable for all companies. Okay, and those are two really big advantages over the DGM. Okay, so the disadvantages, we have to, what do most people use? Will, you know, that is a good question, and I don't have an exact answer for that. I know from my own experience, okay, from working when I was down in Houston, working for BP, even in my early days at Constellation, they would kind of have a hybrid approach. All right, both companies paid dividends, but also both companies had market risk premiums that were kind of very, very different from one another because they operated in different sectors. But we would kind of use a hybrid of both the DGM and the CAPM models. Okay, so I don't have a specific answer for you, Will, I'm sorry, but all I will say is go ask. Call your treasurer on the phone, send them an email, ask them which measurement they use. Maybe they don't use either one. Maybe they have, your own firm has their own way of measuring the cost of equity, all right? And that would be something that you could very easily find out, all right? So I would encourage you, you know, my job as your professor is to give you kind of the most common methods for how firms go about determining these kinds of metrics. But in reality, every firm is different, okay? So call your accounting department, call your treasury department, call your cash management department, call your CFO, send them an email, call their secretary, send them some flowers, whatever it is, get in front of them and ask some of these questions. It's important to understand how your firms are going about evaluating projects, because guess what? If you've got a project that you want to get approved because it's on your performance chart for the year, you might want to have a bit of an understanding about how decisions are getting made about the projects that you've got going on. So the more information that you've got about how the firm is going to go about selecting projects, the better chance you have of your project getting implemented, period. Okay. So again, with the CAPM, okay, we are trying to forecast some sort of expected market risk premium, okay, that's going to be consistent over time. All right, so as the risk-free rate of return changes, as inflation changes up or down, whatever, okay, our expected return is going to move up or down consistently based upon some basis point differential above that risk-free rate of return, which is the market risk premium. Okay, so we're making that assumption that we're not going to have a convergence or divergence of the risk premium as it relates to the risk-free rate of return. Okay, that risk premium is going to stay constant for eternity. Okay, it's a big assumption. But for large companies, okay, you can almost easily make that assumption because it's very rare that large companies pivot in such a way that creates such a drastic shift in the company's focus that overall risk premium for the firm, okay, is going to widen or contract to any significant, okay, in any significant way to throw this analysis off. Okay. So we talked about beta, right? Remember, systematic risk. Okay. Think about a company like Stanley Black & Decker or Legg Mason or even Exelon for that matter, BP. Okay. Any company that has different divisions, okay, that operate with different business models in different parts of either the country, different parts of the globe. Okay. Each one of those divisions, right, has a level of risk associated with it that is different from the division in another part of the country, another part of the world, within another product line. Okay. So when we talk about beta, okay, we can take the concept of CAPM not only from the corporate level, the firm level, but we can push that concept of CAPM, cost of equity, okay, expected return. We can push that down to the divisional level. Okay. And then, just like we talked last week, weighted averages. I don't think Morgan's on the call right now, right? Because I know she'd love this, but we talked about weighted averages. Okay. We can take those weighted average expected returns of all the different divisions and within the United States, around the globe, right? We can take all of that and we can weight everything to create a firm level cost of equity. Okay. So this doesn't just apply at the firm level. You can push this CAPM model down to the divisional level, okay, to evaluate, which is what needs to happen, right? That's what you want. If you're working in a division of Stanley Black & Decker, and I'm going to talk out of my butt on this, but you're working in, the hammer drill division of Stanley Black & Decker, right? You need to understand what the cost of equity is for your division. Because if you're evaluating, a manufacturing line expansion, which is going to cost money, or you're evaluating a product improvement, okay, which is going to cost money, then you better know what the cost of equity is for your division in order to choose one project or the other, because that's the number you're going to be using as your discount rate for your discounted cash flow valuation. Okay, so you can take this concept of CAPM and you can push it all the way down to the divisional level. Okay, so cost of equity, right? So we got a company that's got a beta of 1.5, risk premium is 9, current risk-free rate is 6. We've got some analyst estimates that determine the market believes our dividends are going to grow at 6%. Last dividend was $2. Stock is currently selling for 15.65. What's our cost of equity? All right, well, let's do it both ways. Okay, since the first bullet had beta, the word beta in it, that's a red flag for CAPM. Okay, so what's the cost of equity using the CAPM? Expected return is equal to the risk-free rate of return of 6 plus the beta of 1.5 times the risk premium of 9% gives us an expected return of 19.5% using CAPM. Okay. Second approach, dividend growth model. Okay, expected return is equal to, don't mess this up. Words matter. Just paid. Our last dividend was $2. Our last dividend. So in the model we were looking at, it said D1. D1 is the future dividend, right? So we have to grow what just got paid. So we just got paid $2. It's got to grow at 6%. So D1 is $2 times 1.06. So D1 is 2 times 1.06. Got to grow it. Okay. Divided by our current price. So dividend yield. Okay. Plus capital gains yield of 6%. So our total expected return using the DGM is 19.55. Okay. So the models are reasonably close to one another. Okay. So what we're talking about here is that the similarity, okay, between the two models, right, is simply a function of the inputs that are selected and not necessarily indicative of the two models being similar in terms of the results that they produce. Okay, you can have two drastically different answers. Okay, in this case, however, the inputs, all right, the beta, the risk premium, the risk-free rate, the $2, the 6% growth, the inputs, all right, led to a similarity, right? But you can have a scenario where the DGM and the CAPM can yield two very different results, right? And then you have to start making some assumptions around how do you go about weighting one versus the other? Do you do a straight average? Maybe you have to go look at what Moody's and Standard and Poor's are talking about in terms of the risk factor of your business, and then determining what the most appropriate weightings are to apply to the CAPM and the DGM. Okay, so don't get fooled into thinking that the DGM and the CAPM are always going to reveal such similar results. Okay, they can sometimes yield very different results, and at that point you kind of have to ask yourself some very different questions after that. Okay, so cost of equity, two methods, DGM and CAPM. All right, we've talked about both of those. All right, cost of debt. Okay. Now, this is where we get back into the conversation around yield to market, aka yield to maturity, versus coupon rate. Okay. Do not be confused between the two of those terms. Okay. The cost of debt, okay, is the required return on the debt that we have. Okay, aka yield to market. Okay, what yield, and this is kind of, I've brought you now into where IRR and yield to market converge. Okay, when we were talking about bond valuations and we were using Excel and we were using the rate function, okay, to determine what rate was required in order to force the price to be what it was trading at within the market. Okay. And a yield to maturity, a yield to market, was calculated based upon using that rate function. We're going to move to Excel here in a moment, and I'm going to show you that in the context of cost of debt, yield to market is the same thing as using the IRR function, the internal rate of return, okay, that we could expect to receive on the debt that we own. Okay, and I'll show you that here in a minute. Okay, so we're bringing all of this together, right, so that we can calculate cost of equity and cost of debt. Okay. So typically, we're usually focused on the cost of our long-term debt, right? The cost of our short-term debt, I mean, don't get me wrong, like it is important, right? But it's typically tied up in our net working capital calculations. In our normal operating activities of the firm will typically cover right? Most of our short-term debt obligations. And when we talk about the cost of debt, we're typically focused on that long-term debt, and bonds. Okay, so the required return, okay, is best estimated, okay, when we compute the yield to maturity on our existing debt. Okay, that is the expected return in the market. The prevailing market rates dictate, okay, what the current price of our bonds are worth. Okay, the value of our debt isn't what the value of it was when we took out that note. The value of our debt on our balance sheet is based upon, okay, the prevailing market rates. Okay, plain and simple. So the required return is best estimated when we compute the yield to maturity of the debt that we have on the books. Okay. And then, in addition to calculating that number, okay, which is based upon our actual portfolio of debt, okay, we can also use estimates, right, of current rates that are based upon the bond ratings from S&P, from Moody's, that we expect to receive when we issue new debt. Okay, so the important note here, this final bullet is really, really important. Okay, and I want you, if you print these slides out, if you're on your iPad or whatever, however you watch this, I want you to circle this final bullet here and put an asterisk next to it and say, remember this for a Royal Mail case study. Okay, this final bullet is important for that case study. The cost of our debt, as it relates to the weighted average cost of capital, the cost of our debt is not the coupon rate. Okay, it's not the interest, the debt service that we're obligated to pay to our debt holders. Okay, the cost of our debt is related to prevailing market rates. And when we talk about prevailing market rates, we're talking about the yield to maturity, the yield that is required in order to set the net present value of our future cash flow streams related to that debt to zero. Let me say that again. The yield to market, okay, is the IRR, is the yield that is required in the marketplace in order to set the present value of our cash flows to zero. I'll show you that in Excel here in a minute. So suppose we've got a bond, it's currently outstanding, 25 years to maturity. It's got a coupon of 9%. Coupons are semi-annual. Bond is selling at a discount. Okay, 908.72. What's the cost of the debt? All right, so how do we go about calculating what the cost of the debt is? All right, well, again, remember back to Excel. Equals rate, equals RATE, open parentheses. And you've got everything that you need right here in front of you. Okay, you have the number of periods, 25, semi-annual, so 50 periods, right? You can calculate what the coupon is per period, okay? 9%, okay? So you're getting $45 every 6 months, okay? You know the present value is a negative 908.72 because that's the price. You know the future value is the par value of 1,000. You've got all the variables you need. Open paren, shove it all in, close the parens, hit enter, and you will get a 10% number when that calculation is complete. Okay. Would you like for me to do this in Excel? Okay. Let's hop over there real quick. Okay. So let's just kind of blow this up a little bit. All right. So we have the coupon rate. Just doing variables here. All right. 9%. Okay. We have maturity of 25. We have current price of 908 spot 72. And we know that par, because we've done this before, is 1,000. Okay, so what's the cost of our debt? What is the expected return? What is the yield to market? What return is required in the market today in order to make the present values, okay, of this bond equal to the current price? Okay, essentially, what's the IRR of this bond? Okay, so yield to market is equal to the rate times the number, first variable, number of periods. So we've got 25 years times 2 compounding periods. Don't forget the compounding. Okay. What's our payment? What's the coupon payment that we get each compounding period, right? Well, we get 9% times 1,000, but that's on an annual basis divided by 2. Okay, so that on a 6-month basis, that's what we're getting. What's the present value of the bond? What would we be willing to pay today for this bond? Well, it's the current price, right? So remember, PVs are negative because it's cash outflow. So negative present value. And then finally, what do we expect to get in the future 50 compounding periods from now? Well, we expect to get the par value back, right? And when we do that, we should get 5%, which is completely correct. Anybody want to tell me why we got 5%, but the slide says 10?
It's the semi-annual percentage.
Yeah, thanks, Jared. Right on. So because the yield to market is based upon semi-annual compounding, okay, we have to multiply that times 2 for annual. Okay, so don't forget your compounding. Okay, right? So the equals rate function is really helpful. That's how we can go about calculating this. But I'm going to show you here in a minute how the rate and the IRR converge and deliver the exact same results when we think about things in terms of cash flow. Okay, when do we receive cash flows from the investments that we have? If we're going to buy something, we shell out money today. We expect to get future streams of cash flows into the future. We have to discount those back to today's dollars, and therefore we can now equate the internal rate of return to the rate calculation, or AKA yield to market. Pretty cool shit. I love finance. Okay, so remember, preferred stock gets treated very similarly to, okay, bonds. Okay, because no matter what happens with the interest rates within the market, okay, you still get that preferred stock dividend that you bought. Okay, so it's no different than buying a bond that pays you a consistent coupon rate, okay, every 6 months. Okay, if you buy preferred stock, you're buying preferred stock at a certain rate, a certain dividend yield that doesn't change. So when we think of preferred stock, what is the cost of preferred stock? Preferred stock pays a constant dividend every period, okay? And those dividends are expected to be paid every period forever. Obviously, that's a big assumption, but nonetheless, when you buy preferred stock, okay, you have rights prior to the common stock shareholders receiving their dividends. So you get cumulative preferreds. So you get paid before they get paid. So in a way, the dividend assumption here that they're expected to be paid ad infinitum is a little more accurate than the DGM model, where we're expecting those dividends to get paid from a common stock standpoint ad infinitum. Okay, so what we need to start thinking about here is the preferred stock being modeled as a perpetuity. Okay, so the expected return, okay, of a preferred stock, okay, if you remember the formula for a perpetuity, is nothing more than the dividend divided by the current price. Okay, so when we look at that in an example, okay, then the expected return of a company that has an annual dividend of $3 and the current stock price is 25, then we should expect an expected return from that portfolio of 12%. Okay, so 3 divided by 25. So that would be the cost of the preferred stock. Okay. So here we are, bringing it all together now. Okay, we talked about cost of equity, DGM and CAPM. We talked about the cost of our debt, which is not the coupon rate. We're talking about yield to maturity, yield to market, based on prevailing rates. Okay, that's what matters. We care about what's happening in the market. Okay, so we can use the individual costs of capital, cost of equity and cost of debt, to determine the average cost of capital for a firm, right? Which is really important because the firm is either financed one of two ways, through debt or through equity. So the average that we're referring to, this weighted average, okay, is the required return on all of the firm's assets based upon how the market perceives the level of risk associated with the assets that the firm owns. Okay. So whether it's debt, whether it's equity, it's a measurement of how risky we perceive all of the assets of this firm or the division that we're referencing, the level of risk associated with this. Okay. And the weights are determined by how much of each type of financing we're using within the firm. How much of our firm's value is financed with debt, and how much of our firm's value is financed with equity. Okay, so we're going to have 3 different variables that we need to kind of look at: the total market value of the equity, the total market value of our debt, right, and the total market value of the firm. So when we talk about these 3 variables, okay, the E, if you will, equity component is simply the market value of the equity, right? Which we've talked about this early on this semester. You may not remember, okay? But it's the market capitalization of the firm. What's the value of the equity in the market? And when we look at market cap is nothing more than what's the stock trading at today, right? And how many shares are outstanding in the market. The product of those two is market cap equals market value of equity. Okay, so E, market value of equity, equals market capitalization equals shares outstanding times stock price. D, the value of our debt. Okay, how many outstanding bonds do we have? Okay, and what's the current price of those bonds? Okay, not what we paid for it necessarily. It could be what we paid for it in some ways, but I think you understand what I'm saying. It's the market value. So whatever the price of our bonds are based upon prevailing rates in the market, yield to market, times the number of bonds that we have, okay, that's the total value of our debt. Okay. And then finally, the value of the firm, the market value of the firm, right, is the debt plus the equity. Okay, so V equals D plus E. And because you're all smart people, I don't need to go back and tell you what we talked about when we dealt with weighted averages. All right. The weights of each one of these are easily calculated. The weight of equity, W sub E, is the value of the equity, the market value of the equity divided by the value of the firm. The weight of the debt, W sub D, is equal to the market value of debt divided by the value of the firm. Okay. And those two numbers give us the percentage of our firm that is financed using debt versus equity. Okay. From a capital structure standpoint. Okay, from a capital structure standpoint. Right. So when we think about how we go about calculating these weighted variables, okay, I'm gonna go through this really quick because again, you guys are all smart people, you can figure this one out. But we've got an equity value of 500 million. We've got a debt value of 475. Our total value of the firm is the sum of both of those, or 975 million. So the weighting of equity versus the weighting of debt, we take the 500 of equity divided by the 975 in total, and we get 51.28% of our firm being financed by equity. Okay. And then 1 minus that number obviously gives you the other component related to the debt. Okay, so a little over 51% of it is financed using equity and the remainder is financed using debt. Okay, now, what do you think we also need to consider if we're talking about cost of capital, right? And we're talking about coming up with a number, weighted average cost of capital, that's going to be reflective of the cost of equity for our firm and the real cost of debt for the firm. Okay. What's something that the company is able to kind of take advantage of, okay, when it relates to debt financing that you don't get to take advantage of with equity financing, right? There's something that you get to take on your income statement as a benefit to you if you finance some of your business with debt that you don't get to take if you are paying dividends. Anybody have an idea? Interest deduction. Good job, Will. Okay, so for the portion of your business, okay, that is financed using debt, right? You get an after-tax benefit, right? You get to deduct the debt service, the interest that you paid on your debt on your income statement to lower your overall tax obligation. Okay? But on the equity side, you don't get any sort of income statement benefit, tax benefit for paying dividends. Okay. So we need to have a way where we bring in some sort of after-tax model, okay, to this cost of capital, weighted average cost of capital conversation. So what we're concerned with, okay, is our after-tax cash flows, right? That's what we really care about, our cash flow from our assets, right? Operating cash flow. And if you remember back to the third or fourth lecture when we were calculating operating cash flow, right? And we were looking at EBIT adding back depreciation, but we subtracted out taxes, right? Because that's a real cash flow item. We need to adjust our cost of debt, okay, for the taxes that we expect to pay, okay? So we need to consider the effect of taxes on our costs of capital, right? So our interest expense reduces our tax liability. We know that from our income statement days early on in the semester. Yes, subject to some limitations, but we're just going to assume that it's a full-blown tax liability reduction. Okay, so therefore, our after-tax cost of debt, okay, is the expected return on our debt multiplied by 1 minus our tax rate. Okay. And since dividends are not tax deductible, there's no impact to the equity side of the weighted average cost of capital calculation. So when we get into the final weighted average cost of capital analysis, we're left with the expected return of our equity, our cost of equity, times the weighting of our equity, plus the weighting of our debt times the expected return of our debt, aka yield to market, times 1 minus our tax rate. And that is the weighted average cost of capital. That is how your firms will most likely go about determining what their thresholds are for the business, okay, based upon their debt and equity capital structures, right? So the weighted average cost of capital is equal to the expected return, the cost of equity, all right, either using the DGM or the CAPM or both in some weighted average form to create a weighted cost of equity. The weighting of equity, so equity divided by the total firm value, plus the weighting of the debt, so 1 minus the weighting of the equity gives you a weighting of the debt, times the expected return on the debt, which is the yield to market, aka IRR. We'll show you that here in a second. Adjusted for taxes, because you get the benefit of the taxes on your income statement. So we need to adjust our weighted average cost of capital for that. So, example time. Equity. We got 50 million shares, 80 bucks a share. The beta is 1.15. So the beta is telling us that in this example, this firm has 15% more systematic risk in their business as it relates to the market in total, okay? More systematic risk equals higher beta, or beta greater than 1. We've got a market risk premium of 9, and we have the risk-free rate of 5, right? That's our equity side. On the debt side, okay, we have $1 billion in outstanding debt. That's the face value. The market is currently quoting 110. We've got a coupon rate of 9%. We've got 15 years to maturity, and we have a tax rate of 21%. So let's go do some math. End game, end goal, calculating weighted average cost of capital, okay? Naturally, on the equity side, since we're given information that uses beta, we go right to CAPM, right? So we know that the cost of equity is going to be determined based upon the CAPM model. Done, okay? Plain and simple. We're given coupon rates, we're given current quotes, we're giving outstanding face values, we're given times. We're going straight to yield to market calculations on the bonds, okay? And we're told tax rate, so therefore we can now calculate the adjusted after-tax cost of debt, okay? So what's the cost of our equity? Using the CAPM, our expected return of our equity, cost of equity, risk-free rate of return, plus the beta times the risk premium gives us 15.35%. Done, okay? In the bag. What's the cost of our debt? Okay, we go to Excel. We go to Excel. Okay, we go to Excel, and we have a coupon rate of what's our coupon rate here? 9%. Okay, we have a maturity of 15 years. We have a current price of 110. Okay, we know the par value is 1,000. Okay, so what is our yield to market? Please tell me that's what we got here. Yes, yes. Okay, so our yield to market, okay, 7.85%. Okay, so our cost of debt, not adjusted for tax, okay, is 7.854%. Right? We adjust that for tax. Okay, and we take the pre-tax adjustment, the expected return, our cost of debt. We take 1 minus our tax rate of 21%. Okay, and we get an after-tax cost of debt of 6.205%. Okay, so we got some variables. All right, we got the expected returns for our equity and for our debt, right? So we've got half of our equity done and half of our debt done. Now we got to figure out what percentage of our firm is financed with equity versus debt to create weighted average to then get to weighted average cost of capital. Okay. So step 2, what are the weightings? Well, now we have to calculate the market value of the equity and the market value of the debt. Add the two together, gives us the market value of the firm. So what are our capital structure weights? Okay. So we've got, on the equity side, we said the value of our equity was the market capitalization of our firm, which was equal to the stock price times the number of shares outstanding. Okay, we were trading at $80 a share, and we had 50 million shares outstanding. So the market value of our equity, the market capitalization of our company, is $4 billion. Okay. Our debt was the number of outstanding bonds that we had based upon the market price of those bonds. Well, the market price of those bonds was being quoted at 110. And if you remember from the pricing, the quote tables for bonds, okay, all we have to do is take the 110, okay, and it's 10% more than par value. That's what the 110 means. 100 would be at par. 110 means you're 10% above par. Therefore, you have 1 billion bonds that were outstanding at 10% above par. Therefore, the market value of your bonds is 1.1 billion. Okay, and you know, the total value is the equity plus debt of 5.1 billion. We weighed everything. So the weight of our equity is the equity over the value of the firm. So 78.4% of our business is financed with equity. Okay. And the remaining is financed with debt. So our weighted average cost of capital, okay, in this example is the weighting of our equity, okay, times our cost of equity plus the weighting of our debt times the after tax, the tax adjusted cost of debt, okay? Not the actual cost of debt, but the after tax cost of debt, because we get to take the interest deduction on our income statement. We get to take advantage of that when we look at the cost of capital for our firm, right? It lowers our weighted average cost of capital because we get that benefit. We get the benefit of that interest deduction on our income statement, which is a benefit to the firm, and therefore it lowers our overall weighted average cost of capital because we're taking advantage of that benefit. Okay, so the weighted average cost of capital in this example is the sum of these two products, and we get to 13.38%. Now, somebody answer this question. Is this good or is this bad? Is 13.38% as a weighted average cost of capital, is that good or is that bad? Okay, Will says seems high. Anybody else have an opinion? Anybody else have an opinion? Annalise, there you go. I think you need more info to determine for a specific company, what information would you need? What kinds of information would you need? What other information might you need to be able to kind of start honing in on whether or not 13.38 is good or bad, or high or low, or reasonable? What are some of the things you might want to know? Industry standard. Okay, thank you, Jennifer. What company, what company is this? Okay. Is this a technology company? Is this an oil and gas company? Is this a telecommunications company, a pharmaceutical company? Okay, so the sector, the industry that this particular company participates within, you need to know that. Okay, so what is the benchmark for the sector within which this firm operates? Okay, they may do a really great job being able to finance, okay, their business using equity, or they may be able to get bonds issued into the market at exceptionally low rates. And they could be in the same sector as another company, but their WACC would be totally different. Okay. So think about that. When you see weighted average cost of capital numbers, you need to ask yourself, what is this in relation to? What am I comparing this against? Especially within the companies that you work for, right? Because if you're given a weighted average cost of capital, AKA discount rate, that you are going to use to determine the net present value and IRR of a project that you're working on implementing within a subdivision of your firm, it's probably not appropriate to use the firm level WACC, right? You need to know and understand what your division's WACC is, because then it's apples to apples. Okay, back to my hammer drill example, right? You need to know, right, what the hammer drill WACC is for that segment of Stanley Black & Decker, because you are working on projects that are supposed to be delivering more value to the firm for that product. Okay, and so what you need to be using in your discounted cash flow valuation isn't the WACC of the firm. It's good to know it, and you can do the analyses both ways, right? And that's probably what you're going to wind up doing. Okay, you'll have a division NPV and a firm NPV, but you need to look at the spreads. Don't just look at the NPVs based upon the division and the firm. You got to look at the spreads to WACC. Okay, you have to look at that, because that is also indicative of another layer of incremental value added to the firm. Okay, so don't just look at the WACC for the firm. Find out what the WACC is for your division, if it's applicable. Not every company is going to have divisional WACC, right? Some of them are just more local companies. They have a couple of different products. You're operating in a very small space in a small area within the country. Maybe you don't export anything, so you might not have a divisional WACC. But if you're working for a global company and you're participating in foreign markets, you better find out what your divisional WACC is. Okay, because if you're trying to push your project through, right, which you all should be trying to do, okay, you need to be able to better communicate to your managers, okay, how your project not only impacts the division, which will be a comparison to the divisional WACC, but how your project adds value to the firm as a whole. Crucial, crucial, crucial point. Okay. All right. So just to wrap up here, okay, we've got the cost of equity, which we can define as using either the dividend growth model or the SML approach, CAPM. Okay, one of those two. They're not all, remember, they're not always going to deliver such close results as what we saw earlier in the lecture. They could be significantly far apart from one another. And at that point, you kind of have to figure out how you're going to make some adjustments or make some assumptions on which approach you're going to use and why. Okay. So cost of equity, DGM, CAPM. Cost of debt, AKA yield to maturity. Okay. Prevailing market rates. It's not the coupon rates of your bonds. It's not the number of bonds times the coupon rate for each layer of bonds. It's not that. Okay. It is based upon prevailing market rates. We use the coupons that you get from those bonds to calculate what the yield to market is, but it is not a weighted average of the coupon rates. That is not the cost of your debt. All right, and we'll see that here in just a second. Okay, so if you are working for a company that has no publicly traded debt at all, okay, then we're making the assumption that the cost of the debt can then be measured as the yield to maturity on similarly related and rated bonds. Okay, so if you have no publicly traded debt, okay, if you work for a firm that doesn't have any debt, which is probably rare for the folks that are in this class, right? Then you can go to Moody's and Standard & Poor's and you can look at, okay, what the cost of debt is on average for particular rated companies that are in the market. So if Moody's and Standard & Poor's has a BBB rating, okay, on most of the companies that operate within the sector and segment that your firm operates within, then you could make a reasonable assumption, okay, if you're using these other companies as benchmark companies for your own performance, then you could make the assumption that that rating, that BBB rating, and the cost of debt associated with that rating could therefore also be applicable to your firm. Okay, so if you have no publicly traded debt, clearly you have no price of debt in the market, you can estimate the cost of debt if you needed to, with the yield to maturity being that of similarly rated bonds. Okay. And the key point here is publicly traded debt. Not that you don't have any debt, not that you haven't accessed the debt market, it's just that it's not traded publicly. Okay. All right. Once we know the cost of equity, we know the cost of debt, we calculate the value of the market value of equity, the market value of debt, okay? And we weight the cost of equity and the cost of debt by those equity and debt market valuations to determine the weighted average cost of capital, not forgetting to tax adjust the debt component because we get to take that benefit on the income statement. Okay, right? And that, my friends, is the weighted average cost of capital. We talked about divisional and project costs and how it's important to look at the divisional level, even subdivisional level, and depending upon how large your company is, subdivisional level, depending upon the project you're looking at, okay? But you can't always just use, okay, the parent level WACC, right? We have to consider the project's risk relative to the overall firm, okay? If the project has more risk than the firm, we've got to use a discount rate higher than the WACC, okay? We went through this in the Heritage Dahl analysis with the two projects that we were looking at, okay? So you have to look at the project that you're evaluating. You have to be able to assess subjectively, okay, how the level of risk that your project, what it possesses as it relates to the overall firm. And you need to be able to adjust your discount rate accordingly for the level of risk that your project is taking. Okay. All right. Any questions about what we just talked about? Because I want to move into Excel and talk about IRR and rate in terms of cash flows to show you that we've brought that whole IRR and rate conversation together as it relates to the cost of debt and yield to market. Any questions about what we just went through? Because if there are, hit the chat room and I'll try to cover them when we move into Excel. Okay. All right. So let's have this conversation about rate and IRR. So we talked about IRR in the context of our discounted cash flow valuation, net present value analysis. And at the 50,000 foot macro level, right? We have money that we're looking at spending today, cash outflow, right? We have a project that's going to cost us some money to put in place, whether that's pure capital dollars for a physical piece of equipment, or it's pure capital dollars for working capital needs, salaries, things like that, before we start to generate cash flows for the project. You guys did this with Heritage Doll. Capital outlay, future cash flows. Using a discount rate, discounting those future dollars back to today, you summed everything up along with the project cost, the money you were looking to spend today. You summed everything up and you said, if the net present value is greater than zero, we're delivering more value to the firm when compared to other opportunities the firm might be looking at. And then we said, okay, that's great. We have a net present value number. So what's my internal rate of return? What rate of return is required in order to set the net present value to zero, right? So if we have the net present value of a project that's greater than zero, right? So we're adding more value, then what we want to do is be able to compare versus our discount rate, now called WACC, what project adjusted rate of return, what expected return does the project deliver that sets the net present value to zero? That's the IRR. So what IRR, okay, is needed to set the net present value to zero? What discount rate, what cost of capital, what weighted average cost of capital is required in order to set the net present value of the transaction to zero? So let's take a look at this bond. We got a bond with a par value of 1,000, coupon rate of 5%, 10-year term, currently trading in the market at 1,060. Okay. And I want to know, what's the yield to market? That would be a question on your final exam. I guarantee it. Calculate the yield to maturity, yield to market of this bond that you're given. And so you're going to come down here, okay, and you're going to type in the formula for the rate, okay? And you're going to see it as the number of periods, right? Which is 9 total periods, okay? Because we're 1 year into the bond. So in this case, we're 1 year into the bond. So we've only got 9 periods left in the bond, right? The initial term was 10 years. Okay? The payment that we're going to receive, okay, is equal to the coupon that we get every period. So this is an annually compounded bond, obviously, since we only have 9 periods. So we get $50 every year, okay? We know that the present value of the bond is 1060, but because we need to put it into Excel as a negative number, we have a negative 1060. That's the present value. If we're going to buy the bond today, we're going to have cash going out of 1060. And we know that when we get our money back at the end, we get the par value back. That's the future value. Okay. So when we do that, okay, we get the rate or the yield to market of 4.186. Okay. That is the rate that is required in the market in order to set the net present value of all of our cash flow streams to 0. I could shove operating cash flow in here, right? So just like our midterm where you were evaluating projects, correct? And in year 0, you had to spend money to put that project in place, right? And then every year you got a future stream of cash flows. And then in year 9, you got that future stream of cash flow, that $50, but then you had a terminal value. Remember that? That got added to that final year's pro forma to determine that final period's free cash flow. This is no different, okay? Operating cash flow or just cash flows from the bonds. Okay? Same concept. Therefore, in addition to being able to use the rate function, okay, we can also use the IRR. What return is required in the market to set the net present value of all these cash flow streams to 0? So equals IRR. Just like you did on the midterm with the actual project valuation. Bingo. Okay. So now we brought it full circle. And I want you to, if you're not clear and this isn't sinking in, I want you to go back and I want you to watch this lecture again. And I want you to think about the concept of cash flow streams, the concept of NPV, the concept of IRR, what yield to maturity means, okay? Because when you do that, it will now make sense why the yield to maturity for a bond is also the same thing as using the internal rate of return calculation within Excel, okay? All right. Okay. Let's talk about if there's any questions about that, just hit the chat room and I can come back to it. But what I want to do now is I would like to talk about the assignment for this week. Okay. So one of the questions that I intentionally did not cover in tonight's lecture deals with right here. Is the cost of capital set by determined set, okay, by us as managers or by those investors within our business? And I've given you enough information tonight for you to be able to decide which one that is. Okay. But we have a small case, okay, it deals with the British Royal Mail, okay, where they were going through a bit of a transition back in mid 2015 timeframe, okay, and they're trying to determine what their weighted average cost of capital is, okay, and you've got a senior financial analyst who is trying to figure this out, and she enlists a friend of hers, this gentleman by the name of this bloke. If we're talking about Brits, we ought to call them blokes. This bloke, or that's Australia, I guess. This gent by the name of Kyle, okay, to help her try to figure out what the weighted average cost of capital is for the Royal Mail. Okay. And he goes through and runs his analysis, determining using his own methods, the cost of equity, his own methods for determining the cost of debt. Okay. And your job is to look at the way that he went about doing that, his methodology that he used, and decide whether it is realistic or not. And it's not. I'm just going to go ahead and tell you that. So don't think that you can just get out of this assignment by saying, yes, it's realistic. Thank you very much. It's not realistic. So why is it not realistic? Okay, what would you do differently about it? There's a spreadsheet that's within the assignment here that you can use where I've translated all of the, or converted all of the exhibits within the case into Excel. And there is one file towards the end, okay, that I'll open up now. One tab, I should say, okay, called the WACC, W-A-C-C, right? And you need to fill this out. Okay. So what's the book value of the debt? What's the book value of the equity? Okay. What's the current yield, the yield to market on the Royal Mail bonds? What are the rating agencies' average bond yields to market for this particular investment grade rated bonds that Royal Mail has? What's the risk-free rate of return? What's the beta? What's the market risk premium? So therefore, what's my CAPM cost of equity? What's my tax rate? What's my WACC? And then just like we did before in the Excel file, what's my yield to market and what are my cash flows? Okay, so based upon your analysis of what the weighted average cost of capital might be for Royal Mail, I would like for you to write, at a minimum, if you can get it all into one page, all the better. Okay, just a little summary reaction to your findings. Do you agree with Kyle? Why or why not? Okay. What would you do differently? And based on what would you do differently, use the Excel file to calculate the weighted average cost of capital using your methodology, like we talked about tonight, for the Royal Mail. Okay. What are some of the flaws that you found in the way that Kyle went about determining his weighted average cost of capital? Okay. And that bullet that I told you to circle 5 times and put an asterisk next to it, that should be in your paper. Okay. And then what are some of the best practice principles that you took away from this case that you can apply to your own firm, okay, in determining the weighted average cost of capital for your firm? All right. Does anybody have any questions about the assignment or just about the WACC in general before we talk about the final exam? Everybody's quiet tonight. Too much turkey. Okay. All right. If you got any questions, just reach out. All right. I'll be around all week. Okay. Final exam. I'm going to go ahead and stop sharing all this right now. Okay. All right. Final exam. Final exam. So we do have class next week. I did get confirmation back from the program that we do have class next week, and then our exam will be the week after next. So next week we will have a lecture that deals with the basics of options, the futures markets, how to go about drawing and calculating the payoff and profitability diagrams of call options, put options on the buy side and the right side. So we will, and I don't mean by the right, R-I-G-H-T, I mean by the selling side, the writer side, W-R-I-T-E-R, the writer side. Okay, so calls and puts, buys and rights. So next Monday's lecture will deal specifically with the futures and options markets. And the final exam, all right? We will wrap up our class tomorrow, next week at 8:30 or so. I will post the final exam, all right, on Wednesday morning. All right. It'll be a combination of an assignment that's put on Connect and a separate assignment that I will create that deals specifically with options, where you will need to draw the payoff and profitability diagrams for 4 different types of options. Connect will obviously take care of itself, and there will be an upload Dropbox on Moodle for the options component to the exam. Okay. My thoughts are right now, but I will make sure to clearly communicate those to you when I finalize them. My thoughts are right now that 20% of the final grade will be related to the options assignment, and 80% of the final grade will be related to the Connect assignment. The Connect assignment will contain the information that we discussed post midterm. Okay, so I'm not going to make it comprehensive. It's going to be incremental in nature. Okay, so from post midterm to pre-options, that will be on Connect. So what we talked about tonight, what we talked about last week with the CAPM, what we talked about week prior to that with stock valuation, bond valuation, lessons learned from the capital markets history, standard deviation, calculating variance, that will all be handled via Connect. Okay, I will put a practice exam up on Connect, right, between now and the end of this week. So you'll be able to get some work done on what will be contained within the Connect portion. Okay. When we complete our options assignment, okay, or our options lecture next week, right, I will have a supplemental options assignment for you that you can work on prior to the final exam being released on Wednesday. And then we'll be done. And so the exam will get released on Wednesday, okay, after our final lecture next week. And you will have until the following Tuesday at 9 a.m. to submit everything. Okay, so that'll be Tuesday the 15th. Okay, so you'll have Wednesday, Thursday, Friday, Saturday, Sunday, Monday. So you'll have 6 days to complete the final exam. Does anybody have any questions about all of that I just said?
Yeah, Professor, I just have a quick question.
Yep.
The Connect part of the homework, did you say last week that that's going to be all multiple choice? Or are we going to be having to enter in formulas? Because the only reason I ask is because I know for me, like on some of the homeworks, when I enter in a formula, it's really finicky. So I'll get the right answer, but it still marks me wrong because I either like hard coded in a number or within the formula or something like that.
So you'll have to put the answers in the way that Connect wants it. So if it wants it to 2 decimal places, put it in for 2 decimal places. What there's not a good way around this. Let me give some thought. There's a way that I can use Moodle to do this. Okay, where you can hard code your answers into Moodle. All right, and I can give a range of reasonable answers. All right. But that's more work on y'all's part by having to complete the assignment and then re-enter data into a separate, LMS system. What other issues have people been having with Connect?
Just sort of as a point of clarification, I've noticed that the Connect terminology is generally like more book focused from stuff that we've gone over in class. So should we be like studying the book chapters to kind of get prepared for it also?
Well, I hope that you're reading the text as well as participating in the lectures for sure. And you're 100% right. And quite frankly, the text that we're using for, this semester, every single corporate finance textbook uses different terminology, different variables, different names for things. But in reality, like it's all the same stuff. So there's not a whole lot that I can do about that. What I've tried to do this semester is at least communicate with you the verbiage and terminology from the real world, that when you're speaking with folks within your own finance departments, that you can communicate with them in words that they are going to understand, and not just, you know, academics. So you should definitely be, you know, reviewing the chapters. And with 6 days to take the exam, and having access to your text, and having access to, you know, all of the resources that you need, aside from, you know, other students in class, you know, you should be just fine. Trust me. It's not going to, I'm not the kind of professor that's here to like screw you on your final exam. I just want trying to test to make sure you understand and walk away from this course with a solid foundation for finance.
Another thing that's helped me, and this is probably a non-starter, but the check work button has been like a godsend on anything where like a formula is involved, because like Annalise said, like if you don't type the formula in a very specific way, even if the number is right, it'll kick out like a wrong message. I've had that happen to me.
Okay.
So
I can
I
turn
don't,
that on.
I mean, I know that's basically telling us whether we're right or wrong or not, but maybe on questions that require like Excel formulas, if that could be on, just to make sure that we're typing it correctly.
Here's the thing. I have no problems turning the check work option on at all, because part of getting something wrong is learning where you made your mistake. And I can tell you that you are going to have bosses, managers in your career that, just to, you know, to Annalise's point and to your point as well, if you don't show them the numbers to the third or fourth decimal place like they ask for it, they will put it back on your desk and tell you to piss off. Okay. And if you're working in finance, I'd rather you get used to being able to see where the mistake was, go back and fix it. Even if everybody in the class gets a 100% on the connect, that's great for me. And if you had to do it 3 or 4 times to get the right answer, then you did it 3 or 4 times to get the right answer. And you probably learned something along the way doing it the 3 or 4 times. Okay. So I have no problems turning the check work on and letting that be, you know, the way that the connect stuff works for the final. But as you know, in your own jobs, you probably have managers right now. They want things a certain way. All right. And so I'd rather you get 100% on the connect and do it 3 or 4 times before you get the right answer than not. Does that seem fair?
Yeah, I think that would help a lot, especially with like the sort of quirks that are in Connect.
Yeah, no problem. I literally had the CFO call me a rounding error one night at 2 o'clock in the morning. David, you know, you realize you're just a rounding error. Yeah, that's awesome.
I mean, probably not, since he was up at 2 in the morning thinking about you.
Right. Oh no, we were in the office. So, okay. Any other questions about the final? I will see you next Monday. Okay. We will talk options in the futures markets. It'll probably run 2 hours, 2 hours ish. If there's anything in particular about the options or futures market that you'd like to learn more about, shoot me an email or something this week, and I'll try to add that to my list of things to talk about.